Okay, so for anyone watching this after the live one, we are Friday, December the 5th, 2025. This is the open call. Okay, so let's start. Pascal wants to talk a little bit about nominal yields, real yields, tips and things like that. That's quite no problem, Marco. That's quite a complex issue. So first of all, let's start off. Yassine has I think a trading question.
Yes, Angus, I have a trading question for
Go
you.
for it, Yassine. I'll do
Okay,
my best
so
to answer.
thank you. So as you know, Angus, yesterday we had a significant lower than expected initial jobless claim. And after the data hit, my expectation was that we should have a less dovish expectation about next Fed meeting and the sell-off in bonds, wherever it is the short end or the long end. However, the reaction of the market was muted. I'm talking about the bonds market and
Yeah,
measure as other asset class.
yeah.
And I didn't understand why I lose money, so I had three potential explanations that I would like to discuss with you. The
Okay.
first explanation is that the market is focusing right now on the Fed narrative about the potential next Fed chair. So he's not giving too much weight on the macro data. The second explanation is that we are in the Fed blackout period. The other recent macro data release, ISMs and ADP show a weakness in the labor market. So this time the market ignored the initial jobless claim, while usually it take it seriously at least for an hour or two. And the third potential explanation is that there is no real explanation behind that, and there is nothing we can understand about. Sometimes we lose the money, sometimes we make the money, and this is the macro game.
Yeah, okay. So great question. So let's frame that, Yassine, and for everyone in a general context that when data is released, do markets act as they should always? The answer is no. And Yassine, that was actually a very good explanation of the possible reasonings. At any given moment, we don't really know what the market wants to do. So you have to understand that there's going to be some times where it will go more than expected, other times less. So, for example, this morning we had Canadian data, which was a strong employment number, and for me, the Canadian dollar moved. A bit more than I anticipated because if you look at the Canadian data this morning, there are about 50 or 60,000 jobs added, but most of them were part-time, which indicates, it's not such a great data point in my view. But the Canadian dollar went up against the US dollar strongly. So Yassine's point is, let's have a look. And I'm just going to go on the chart. So Yassine, we'll go back to yesterday. Um, actually, hold on, let me, what can I do here? I'm going to, um, actually, hold on, give me a second here. I'm going to open up something, guys. USTs. So we've got here the US. Just by the way, anyone who likes to trade bonds or is trying to learn about bonds, this is the way I have my bond thing set up on TradingView here. So you see here, you've got a 3 minute. So I've got the 2 year here and the 30 year. Always very important to see the difference. And then, hold on, let me just move all this down here. And then here you've got the curve. Okay, so this is the twos to the 30s, and this is the 10-year yield. So what Yassine is basically saying, now Yassine, what are we noticing here? Just in general, obviously the market wants to go down, right? I mean, this is
Mhm.
from yesterday. So yesterday is going to be Thursday, which is here. So it's an interesting one because what Yassine is sort of saying is, well, how can we, hold on, let me make this. Sorry, guys, I've just got a lot of stuff on the screen. Okay, so can everyone see this? This is the 2 year note. So basically what's happening is that yesterday we had initial jobless claims, which were higher than expected, no, lower than expected. So that's indicating a strong labor market. So as we can see here, instead of the bonds, well, they did go down, but then they went up a little bit and then they've been going down ever since. So, so what are you trying to say here, Yassine, that you kind of shorted here and you were stopped out here, basically, something like that?
Exactly.
Yeah.
Yes. Yeah, it
Okay.
was the short-term reaction was what
Yeah.
what now is what it was a muted reaction. It wasn't
Yeah,
even
that's the
drastically
thing.
wrong.
So you could say that actually the market, did what it needed to do. But I think your initial explanations, Yassine, is quite interesting. That first of all, the data at the moment, guys, it's very strange because a lot of the data, as we know, is from a month or two ago, and then the initial jobless claims. Keep in mind, Yassine, it's as you know, it's a 1 week data point, so it's
But
quite
it's a
messy.
recent one. It's not a delayed one.
I know, but what we have to understand, like you have to look back and keep in mind that when people, let's look at the chart here. So I'm going to put this up here. So if we look, um, the thing is, you always have to look at data, what's been going on. So what can you tell me? This is a 3 minute chart, guys. So it's very important as you go into a data point to look at what's been happening, right? So think about it. From 8 o'clock on of the previous morning, so 24 hours before, what would you say the market has been doing, Yassine? What has the market been doing?
The bond market was downtrend.
Kind of going down. So the thing is, when you always have to look at what's been happening before. What's the context? So the context here is that the market going into the data, let's say at about 8:20. You see here 8:20 when the bond market opens or the cash bond market opens. The point is that a lot of people, the 2 year, just as an example, the 2 year from, let's say, 24 hours previously had already gone down about 25 ticks, which is, not nothing. It's something, right? So it's already gone down 26 ticks. So the question, what you have to always ask yourself when you're trying to do very short-term trades on data is, okay, is the market clean or is the market not clean? And I would say that in that particular situation, the 2 year bonds, the front end bonds, had already come down quite a lot before the data was released, right? So then the question is, okay, is the new data, the new information, is that substantial enough or important enough to justify a further move, an extra move? Do you see what I'm trying to say? Let's say, for example, going into that data yesterday, the ZT, the 2 year bond, had been completely flat. Like, the chart's like tick, 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 nothing. You go, okay, maybe the bond market would have moved more. But the fact that it's already come down 20, 25 ticks, you have to say to yourself, oh, okay, like, is this initial jobless claims one data point going to move the market substantially? And I would say to you, maybe, maybe not. It's not a super high probability trade at that point. Now, I know that's an annoying answer, but that's just reality. The other thing as well, if we want to go more specifically, is that the initial jobless claims, does everyone know what the initial jobless claims are, by the way? Everyone understands it's the weekly number of new people applying for unemployment benefits. The problem with that number is that some of the other labor market data is not available. The most important stuff like non-farm payrolls and things like that, they're just not available because of the government shutdown. And the other thing we have to keep in mind that, for example, if you look at the Revelio private survey, which I was looked at yesterday, if you also look at the some of the other things, ADP and some of these things, they were a little soft. So the point is, Yassine, is that in the context of the available data on the employment situation in the US, it's not obvious that, like, let's have a hypothetical, a counterfactual, as they call it, a hypothetically different situation. Imagine if ADP had been strong, if the Revelio data had been strong, ISM services and manufacturing had been very strong, right? And then the initial jobless claims yesterday came in strong. It's like a cumulative effect. You see what I'm trying to say? It's like an exponentially expanding cumulative effect. And the market would go, oh my God, wow, like, you know, the employment situation is really strong. You see what I'm trying to say? And that's not the situation. It's a bit ambiguous. So I think the market looked at the initial jobless claims and said, okay, it's kind of strong, but we have we don't really know. It's ambiguous. So if something's ambiguous, the market does not need to make a big move, especially in the context that the ZT bonds had already come down 20, 25 ticks in the previous 12 to 18 hours. Okay. The second point is that why would the ZT, the short-term bonds, come down? Like, what is the
Because
ultimate logic? The ultimate logic is, oh, that will cause the Federal Reserve to maybe not cut in December, this coming Wednesday. Agree? Like, that's
yeah,
the ultimate logic. Well, I mean, I'm simplifying a little bit. So the question is that the case? Is that the case? And I would argue that Jerome Powell, as you know, as you just said, the Fed is in its blackout period, so no one at the Fed is speaking about monetary policy. At this point, I mean, what's priced in, guys, for next week for the Fed? Let's have a quick look.
87%.
87. Okay, so we'll just put it in just to refresh our memories. Oops, let's go here. Fed Watch. So 87%, exactly. Okay, so the question is, you know, is that data going to be enough significantly to move? Maybe a little bit, maybe a little bit. But we know that Jerome Powell on Monday had a speech. Did he mention anything? That was his opportunity to tell the market, hey, maybe we're not going to cut in December. What did he say?
You said nothing about
He said nothing. And if Powell genuinely wanted to bring the market back to 50%, that was the last opportunity. So at this point, the market has said we don't need to change the Fed the pricing. Now, you could argue that something like ZT, as we discussed last time, is actually accumulation going out to 12, 18 months into the future. And, actually, it has come down a little bit over the last 24 hours. So I would say, Yassine, that's an unfortunate situation. I think your logic was correct. It's okay. The only problem I would say is just try and think a bit more about the context, especially what the ZT has done, had done, had been doing prior to that release of the data. And the fact that it's come down 20 ticks, you go, I've got to be careful here. Or at least maybe wait for a retracement to P1. Because what we saw from the data, sorry, from the chart, if I'm not mistaken, is that it did actually, is this it yesterday? Hold on, where is it? Hold on, what was yes? No, Thursday. Oh, no, it's here. Okay, so probably a better risk reward. Of course, it's very easy in retrospect. So can you guys see this here, this black chart here? So 3-minute chart. If we look, you see here, that's where the data is released. Possibly, the fact that it got back here, maybe here is much nicer to say, well, you see the logic, Yassi. The logic is to say, think about the logic. Powell has told us when probably we will cut. Okay. Number two, the ZT itself has come down quite substantially before the data. Number three, it's only one data point, so I have to be careful, and the data is a little bit confused at the moment. The data comes out. What you can say then is, okay, you know what? It shouldn't go too much higher. So I'll just wait for a better entry point, maybe to P1, when the data is released. Now, I know that's easy in retrospect to look at that. Everyone's a genius, 24 hours. But you just have to say to yourself, is this a high probability trade? But I think your logic is okay. And at that point, you just have to have a very strict stop loss, a few ticks, and hopefully you didn't lose too much. You just say, okay, I'm out.
yeah,
And that's it.
two
Yeah.
trades.
Yeah. Okay. All right. Does that help?
Yeah, it helps a lot.
Yeah,
Thank
I mean
you very much, Miguel.
it's okay because there'll be other days where it will just keep on going and you'll make money. So I think the important thing
Especially the
there,
bar, the bar was three times like initial jobless claim was significantly lower. It wasn't like
yep,
6, 7, 18K. It was
yeah,
three.
and as we see that the ZT over the last 24 hours actually has moved down. So
So the timing was wrong.
yeah, I mean, but yeah, exactly. I mean, at that point, if you just want to be conservative, you can say, hey, I like this trade, but data releases are always very strange. I'm going to at least wait until it goes back a little higher. I don't know what price you got. But it's difficult trading data immediately like that. Sometimes there could also be liquidity. Other people want to get out for some reason. You never know. You never know. Okay, do we have Pascal? I'm going to wait you sweat it out until the real yields thing a little bit here. Do we have some other specific questions, guys? No? Okay, so Pascal has a little question. It's sort of the interrelationship of, and Pascal, I might twist this around a little bit about no, yield, nominal yields, real yields, inflation expectations, and tips, treasury inflation protected things. So before we talk about tips, it may be useful just to have a refresher course on a few things. And this is actually quite important and hopefully not going to be too theoretical, but this is important, guys, to understand. If you want to understand tips, which is actually an incredibly complex product, and you've got to be quite careful with it. Because often tips is sold as an ETF, which is, oh, inflation protection. But actually, it's about 10 times more complicated than that. It's really much more about real yields, okay, rather than inflation. What do I mean by that? So first of all, who wants to tell me, like, what is the nominal yield? It's very important we all understand some basic terminology here. So just someone, what is the nominal yield?
Is the real yield plus inflation expectation.
Exactly. So when we talk about, so if we go onto like a very simple chart, so I'll go on to a daily chart. Sorry, guys, I've got a few things up here, so I need to. Um, sorry, just give me a second here. I'm trying to. Everything's a bit complicated here, so I'm going to go on to. Um, hold on, I'm just trying to. I will go here. I mean, this is actually kind of interesting. So, all right, now we'll go ahead. Okay, so if you go onto the 10-year yield chart on TradingView or something like that, and you go, oh, what's the yield on the 10-year? At the moment, let's say it's about 4.1%. As Yassine just said, that is the nominal yield. Okay, so that begs the question, what is the nominal yield? As Yassine just said, it's inflation expectations or inflation plus the real yield. Okay, so let's look into that. What does that mean? So therefore, the question is, what is the real yield? Pascal, what is the real yield?
Minus inflation.
It's the nominal yield subtract break-even inflation. Exactly. So let's say, for example, at the moment, the 10-year bond is 4.1%, and inflation expectations are 2.1%. We expect inflation to be 2.1%. The real yield is 2%. Okay? So the thing is, why is that important? It's important because that actually determines whether the Fed is restrictive, whether interest rates are restrictive in terms of the real economy. I mean, the point, guys, if nominal yields are at 8%, and we go, oh my God, interest rates are super high, but inflation is at 7.5%, that means the real yield is only 50 basis points, 0.5%. So you could argue that actually, yields are quite accommodative because they're basically the same as inflation. On the other hand, if inflation is much higher than the real yield, that means that accommodation is the situation, the monetary policy is very accommodative. Okay. And I just want to point out something. It's just kind of interesting if we look at recent history. That's why I had this chart up here. So what we have here is, yeah. So what we have here, guys, is, what do we have here? Right. So this thick blue line, you see this dark blue line here? This is approximately inflation. Okay. And I'm going back here to like COVID and everything like that. And we know that inflation at the end of 2020 went up. Okay. But let's just for a second, let's look at this other chart. Now, this other chart is kind of interesting because what it is um, it's the effective Fed funds rate subtracting the 5-year sort of break-even inflation rate. So what do I mean by that? Do we all understand what the effective Fed funds rate is? Okay, it's essentially the very short-term overnight interest rate, which I mean, I'm not going to go into too many details, but it's a very short overnight interest rate, which the Fed is targeting. Okay, let's call it the Fed rate, right? The effective Fed funds rate, which today is about 3.88, 3.88. And maybe next week, if the Fed cuts, that will go down 25 basis points. Okay. So what's kind of interesting here is if we look at that, we're trying to see how restrictive the Fed is in the real economy. So there are many ways of doing this, but one way, which is a bit simplistic, but actually kind of effective, I've put the effective Fed funds rate subtracting the 5-year expected inflation break even. Kind of, let's call it the market's approximate pricing of inflation. Now, what can you guys tell me? If we go back historically here, what are we sort of seeing here? Like let's look at COVID and the period coming out of COVID. If you see here, let's say, late 2021 to 2022, all through this period here, what can you guys see? What can you tell me? Pascal, what's going on here? What is this chart telling us?
That there was a significant inflation push starting in 2020,
Right.
mid 2022.
So remember, this chart is two things. It's not the 5-year inflation expectation. It's the Fed funds rate
minus
subtract. So in fact, what this is telling us, and I'm going to go very slowly here,
Yep.
is this is one way to understand. If someone says to you on the street, someone bumps into you, Pascal, on the street and says, someone says, hey, is the Fed restrictive at the moment or not? One way of looking at that is to take the effective Fed funds rate and go, okay. And then you look at inflation. And what we can see from that chart, which is actually a very extraordinary thing in retrospect, is that in this period, so I have to move.
So
right.
the Fed did not start to be restrictive.
Exactly. So what we can see here now, sorry guys, it's really hard for me to see this chart because I've literally got thousands of things here. But what we can see is that in this period here, let's call it the end of 2020 and 2021. Look at zero. Zero represents the point. This is zero. It basically saying that in this period, the Fed's fund rate was actually was underneath inflation. This is incredibly accommodative. And that's why, everything started exploding in stocks and everything like that. Okay. And the Fed did not actually really start to, and we can see this if we look at inflation. Now I'm going to put inflation on. You see what's going on here? So basically at this point, inflation was low in the middle of COVID. And then as we came out of COVID, look at the inflation. Inflation rate just went up and up and up and up. But we can see here that in terms of restrictiveness, there's zero. I remind you, here's zero. The Fed did not become restrictive in a technical sense until basically here, like September of 2022. So in this entire period here, the Fed is playing catch up, right? Which is sort of disastrous. Basically, they were behind the curve. And what we can see is that the Fed continued to hike interest rates. So gradually the differential, because this is showing the differential between essentially the Fed rate and its sort of inflation. And you see how it keeps on going up and up and up until we got a peak of restrictiveness, which looks like about September of 24 at about 3.5%. So what that's telling us is that finally, it took the Fed a year or two. They kept on hiking interest rates. Inflation slowly came down, but the differential remained substantial, which is restrictive, right? And so, in a certain sense, what that's also telling us is a little bit like the real yield. Okay, like really, what is the effective yield? Now, there are all kinds of ways of measuring that. You've got the 10-year, you've got the 5-year. It depends which measure of inflation. There's literally hundreds of ways of measuring that. But essentially, that gives us the essential. And what that's telling you, and you can see the dark blue line, is that the inflation rate, as we know, kind of came down quite significantly. And now it came down and now it's sort of edging up a little bit more. But what we can see from this is that one way of looking at the Fed, when the Fed says things like, oh, we're still modestly restrictive. When Powell gets up and he goes, oh, well, we're still modestly restrictive. You could actually agree with that and argue that the Fed, technically the real rate of interest at the moment is 1.56%. Okay, which is basically saying that, and that's why people like Stephen Miran, Trump's appointee on the Fed, he's going, hey, we should really still be cutting interest rates because by this metric I just showed you, one could argue that the Fed is still, a little bit restrictive by 1.5%. I mean, we can talk about that. So that's the real interest rate. So any questions there, guys? So the point, and this is where we have to understand, getting back to tips a little bit, is that when we talk about yields, it's very important to understand that there are kind of three interrelated factors, and it's quite complicated. Well, I don't want to say complicated, but you sort of have to work in three dimensions, right? If nominal yield, I want you guys to imagine different scenarios. If the nominal yields go up, right? What does that tell us about real yields? Melissa, it's a tricky question.
Sorry, I'm going to have to ask you to repeat that. Go ahead.
Okay, let's say nominal yields go up. We look at
Okay.
we look at, let's say, the 10-year. So what I'm going to do now is just go onto something. Let me get rid of that. Sorry, guys, I'm just going to go onto some yield charts now. So so let's go on to, let's say, oh my God, where's my US? Okay, so there's the 30-year yield. Okay, what can we see? We can see the 30-year yield. This is the nominal yields. Okay.
Mhm.
So if nominal yields go up, so you see here in the last day, let's just zoom in a little bit. You can see here that the yield on the US 30-year bond has gone up. Agree? It's gone up from 4.69 to about 4.79. Wow, 10 basis points. That's actually pretty huge. Oh, this is a weekly chart. No wonder it looks so crazy. There you go. Okay. Yeah, but still, you see it's going up. Now, what does that tell us about real yields? Has the real yield gone up? I think Pascal said yes. Pascal is going like this. So if the nominal yields go up, has the real yield also gone up?
Yeah. Sorry.
No, I was actually going to say. So that chart you said showed us the nominal yields.
Yeah.
Well,
That's
if
probably
nominal
what.
yields are going up, that means inflation is decreasing. So wouldn't that mean?
Whoa, 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 whoa. If nominal yields go up, inflation is decreasing. No, that's a terrible
No, sorry.
statement. That's a terrible
No.
statement, Melissa.
Well, because the real yield is nominal minus the inflation rate, right?
Right. So, but here's the problem or the complexity.
Well, no, nominal yield, wouldn't nominal yield be
The short answer is the following. We don't know.
Okay. That's what I was gonna say, we wouldn't know.
So this is the problem. Mostly if the nominal yield goes up, often people go, oh, I guess, inflation did this or real yields did that. The problem is that you have different scenarios that, so let's say, for example, let's talk about the Fed. And we'll tie this into what's going on at the moment.
I was answering for the real yield. If the real yield was going up, then
yeah, okay, but
Yeah.
here's the point, because what I'm trying to say, this is also about tips. If, for example, we have Trump appoints a new Fed chair, and that person, let's call that person Kevin, what's his name? Hassett. If the market believes that that person is not serious about fighting inflation, let's just look at inflation expectations. What will happen to inflation expectations? So here's the chain of logic. The market goes, okay, Trump wants a puppet. Trump wants lower yields. Therefore, the puppet will not fight inflation or let's not put it that way. The puppet will cut nominal yields, which will expand the economy and probably feed inflation. Inflation will go up.
Will go up.
So we said that the real yield is the nominal yield subtract inflation expectations.
Yeah.
So if inflation expectations are going up, there's a nominal yield, there's inflation expectations. What's happening to the real yield?
It's reducing.
It's reducing. It's getting smaller, right? Assuming nominal yields don't go up. So let's say the nominal yield stays at 4%. It's at 4% this morning. Trump says, oh, my good friend, the dove, is going to the Fed. He doesn't care about inflation. He's going to cut interest rates. What will happen is that the market will push up inflation expectations. So all else being equal, the real yield will get smaller. Sorry, the real yield will get smaller and smaller. Because essentially what's happening is that inflation is getting closer and closer to the nominal yield.
Nominal yield, yeah.
Right? So therefore, actually, conditions are less restrictive. Okay? Now, normally in that scenario, would the nominal yields also go up? Probably yes. But maybe not as much as the inflation expectations. Because, and this is where it gets complicated, because remember, if someone comes into the Fed, they only have the ability to cut at the front end of the curve. So what might happen is that the front end yields may go down. Long end yields may go down, but not as much. So the curve will steepen and the market will say, well, okay, the Fed is cutting interest rates, but really at the front end, and what that's going to do is to stimulate the economy, which could be a bit inflationary and boost the economy, and therefore long end yields, well, they shouldn't really come down too much. They may even rise. And in fact, what's interesting is that you could even have a paradoxical situation that the Fed cuts interest rates and long-term yields maybe actually rise. If the market believes that the Fed is not serious about combating or fighting inflation. So the point I'm trying to make now, what about another situation here where, for example, the Fed has a hawkish person, new chair, who says, yeah, I'm not actually going to cut interest rates that much. We could have the opposite situation that the market inflation will come down a little bit. So maybe nominal yields will go up a little bit because the Fed is not cutting, but the market also says, oh, we quite like the fact that they're fighting inflation. So inflation expectations come down. So look what's happening to the real yield. The real yield is getting wider, bigger, more. So therefore, what does that mean? That means actually the Fed is more restrictive. Okay? So all I'm trying to say here, guys, is that when we talk about bonds and tips, it's very important to understand that you're talking about three different factors. And they're all moving in different ways. And where it gets complicated is that sometimes we, as traders, tend to look at the nominal yield, Pascal, and go, oh, yields are up or down, or inflation is up or down. That's good or bad for tips. Here's the key point. And actually this morning, just before coming on, I did a quick ChatGPT thing. They put a nice little table to explain it, which is nice, is that tips is not so much, people think tips is somehow like, oh, if inflation goes up or down, tips will go up and down. No, 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 no. Very important. Tips is really much more about real yield. Okay, so in order to understand the real yield, you need to be understanding the relationship of nominal and break-even inflations. So if ever you want to be trading tips, as in the ETF TIP, you don't go, oh, I think there's going to be a lot of inflation under Trump, I'll buy the tip. Really what you're trying to trade, I mean, that could happen sort of long term, over 5 or 10 years. Really what you're trying to trade, if you're trading the tip, is the real yield. So therefore, to understand the real yield, of course, you always have to be going, okay, what's going on with the nominal yield? I literally have a piece of paper. You know, it's like this. It's like what's happening with the nominal yield and inflation expectations. And again, what I'm trying to say is that sometimes the nominal yield will go up and inflation expectations will go up. But what happens to the real yield? Nothing. If the nominal yield goes up 50 basis points and inflation expectations go up 50 basis points, the real yield has not changed. But it could be they could go up together, they could go down together, or one could go like this, or one could go like that. There's kind of three different combinations. And that's going to focus on the tips. So just to finish off on this, I'll show you what I got from ChatGPT. It's actually kind of quite good because I asked it to give me the different scenarios. So we've got a few different scenarios here. Can you see this, guys? Pascal, you see this?
Yes.
Okay, so again, this is just good from a trading perspective here, guys. So we'll just go through these, and if anyone doesn't understand it, this is a good way of thinking about the TIP ETF. Scenario A, a hot CPI. So what does a hot CPI means? It means the break-evens or inflation expectations is going to go up. That's pretty logical, right? It's like, oh my God, inflation is going to go up. Okay, now here's the key point. Real yields may go up or down depending on the macro backdrop. TIP ETF reaction depends on the real yields. Okay, so ordinarily, if we get a hot inflation number, number one, inflation will go up. Will nominal yields go up? Probably. Let's look at the logic. Hot CPI, Fed tightening fears, real yields spike, tip prices fall, even though inflation is high. This confuses beginners because tips are inflation protected, but tip can fall in high inflation, right? You know, I might send you guys this. I don't want to talk about this all the time, but this is the point I'm trying to make here, okay? So what I suggest you do, if you want to look at that, the tips chart, what you could maybe do, Pascal, is do something like the effective Fed funds rate, subtract inflation or inflation expectations. I can do it on TradingView if you have that. Obviously, you can do it on Bloomberg. And that will give you an approximation for the real yield. And then what you can do, maybe we can do it, is look at the tip as well. And that'll give you a sense of how they interact. So if we go back here, what we're going to do, guys, we're going to go onto the real yield, which I've got here somewhere. Yeah, so you see on TradingView, I've got it here. So you see this, it's US 10-year nominal yield, subtract the break even. So essentially, this is the real yield as we speak, approximately 1.86, right? So that's the nominal yield subtracting the 10-year inflation. So that's 10-year inflation, quite far out. Okay, so what we can do, I'll take this quite far back. We can overlay, I'm going to put TIP, the tip, putting you price go. Look at that beautiful anti-correlation. Can everyone see that? Very clear, Pascal. What's going on here? It's very simple. As real yields in the black go up, tips goes down. As the real yield goes down, tips generally goes up. That's it, Pascal. That's the answer to your question. So the point is, anyone who wants to trade the tips, you can buy them cash, but if you have millions of dollars, or the ETF, don't think of it as simply, oh, inflation going up, I'll go long or short ETF. It's really the real yield. And it's very clear, you see, it's super clear, like 100% anti-correlated, right? They move in opposite directions. In order to get the real yield on TradingView, you can do something pretty simple. US 10Y, subtract, this is the 10Y, 10-year inflation expectations, i.e. I believe on TradingView, they also do the 5-year. They don't do the 2-year or the 1-year, which is a bit annoying, but they don't. Make sense, Pascal? It's very simple. TIPS is trading in the opposite direction to the real yield. The real yield, just to really hammer it home, is the nominal with inflation expectations. And the problem is that in inflation expectations and nominal yields, there are many moving pieces, right? And it's a bit tricky because if we get data, so let's say, for example, the initial jobless claims Yassine was talking about, in theory, you could say, what should happen to nominal yields? Probably they should go up. What should happen to inflation expectations? Probably that should go up. But it's really the differential is going to determine if the real yields changes, which we don't exactly know, because then you have to put in expectations of what's happening with the economy, and tariffs feed into inflation expectations, and Trump and the Fed. So inflation expectations is actually tricky. So what you can do, what I would suggest is that as much as possible, if you're a macro trader, you should be looking at inflation expectations. Now, on Bloomberg, they have inflation swaps, which is very beautiful because you have 1 year, 2 year, 5 year, and literally you can see every minute inflation swaps. Okay, but we don't have that on TradingView. So you have to look at, but what you can do is to go to the, the Fred website, which is the Reserve Bank of St. Louis. And you can see here, for example, they have the real interest rate, right? So you can go on the Fred website here, and you can see the real interest rate here as well. And they also have inflation expectations. So have a play around with that, right? Real interest rate, for example, there, you've got the 10-year there. So, I mean, it's not perfect, but the point is, if you look at that, you can see, so the point is, guys, if you look at inflation expectations, according to the St. Louis Fed, you can see that they kind of got to a high beginning of this year, and they've actually kind of attenuated a little bit, right? So the point is that the market is relaxing a little bit about inflation, going further up. And that's one of the interesting things. I was looking at the Bloomberg. If you actually look at like the 30-year inflation expectations, all of this year, it's never actually gone that high. The market never really, really believed that inflation longer term was going to get out of control. And really what we saw is that the 1 year inflation swaps were high, but as you went to the 2, the 5, and the 10, it kind of calmed down. So the market was going, oh, we might have inflation for a year or so, but not really in 2, 3, 4, 5, 10 years. Okay, that's maybe enough. Does that help, Pascal?
Certainly does.
Good. Okay.
One more question, if I may. Any chance you have like a table of contents of TradingView symbols for macroeconomic data with
yeah, listen, that's a pain.
Or can I help you put something like that together?
Well, I use a few. Basically, TradingView, it's like the best thing to do, you go on TradingView, they have something called Economy, and they basically pull charts from the Fed, the Federal Reserve System. The best thing to do, I don't have a whole list of them. I've actually found it's quite effective, Pascal. You just type in natural language, just type in 10-year inflation break even or real yield. And also, now that I use ChatGPT a lot, like all of us, I suppose, it's actually very useful because an amazing website for all that kind of stuff is actually Trading Economics is very good as well. Trading Economics let's have a look at Trading Economics quickly. Let's have a look. So if I go to, so for example, you've got the term, so Fred is actually very good, but the best way to find Fred, you can either use the search, I just go to ChatGPT and say, what is the symbol on TradingView or Fred for the 10-year real yield or something? And it's actually a lot quicker because it just goes, spits it out. But another good resource for a lot of data, I'll show you guys because I'm in a good mood, is Yardeni research as well, which is actually amazing because if you go to Yardeni research, can you see that? You go to our charts, they have a huge amount of charts. So you can look at, for example, let's have a look. economic indicator. Where are they? It's always a bit tricky to find. But for example, interest rates, bond yields, like you go here and you've got okay, so you've got if you go on Yardeni, so you've got the bond yield versus tips versus 10-year, you see all this kind of stuff, 10-year tips. There's a lot of there's a lot of stuff in Yardeni. It's actually an amazing site. Mortgage rates, mortgage rates, mortgage rates minus the 10-year yield. So what I would say as well, have a good look inside Yardeni. There's a lot of stuff. On the other hand, if you go to trading economics, I found that they are actually, oh my God. Sorry, guys, I literally can't see what I'm trying to look at here. If I go to trading economics, which is here, and you go on countries, and you go on, for example, the US, you'll see many. So, for example, if you look at, let's have a look. What can we look at? Business government prices. Is it prices? Overview. There's a lot of stuff in here as well. There's a lot of stuff. A lot of stuff. And I'm just trying to find out government debt, corporate tax rate. Anyway, that trading economics is pretty amazing as well. There's a lot of stuff in there. So I would say a combination of if probably the best thing to do, Pascal, would be to understand the 4 or 5 indicators you're interested in. Let's say, for example, real yield, inflation break-evens, maybe term premium, like 3 or 4 things like that. And then just go into ChatGPT and say, hey, what are the symbols on TradingView, Fred, trading economics, and Yardeni research? And actually, it'll give you all of those. And then you can kind of put together your own little thing, really. Yeah. Okay. Alrighty, guys. Hopefully that was useful. Who's still there? Are there any questions in the chat? Let's have a look. Chat. How does this work? This technology. Blah, blah, blah,
Hi,
blah,
Angus.
blah, 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 blah. Okay. Any questions? Let's go ahead.
Not yet, thank you.
I have a question, Angus.
Yeah.
So when it's come to macro even day trading opportunities, are they rare? Like we may have just one opportunity a month, or how many
First of all,
opportunities
okay,
on average in a
in terms
platform
of
trade?
yeah, well, I mean, that's obviously a difficult question. The question is, day trading macro data events. Uh, I would say, first of all, at the moment, it's very strange, Yasin, because no one knows whether, like, it's difficult to trade stuff from 2 months ago. Everyone's like, well, who cares? So it's very difficult. I think probably we'll have to wait until January or even February. Okay. The other thing as well, you always have to understand the best opportunities, you always have to understand where the Fed is. If the Fed, as you know, is fully priced at 90% to do X or Y, the market's like, well, who cares? Really, the market is going to move really on Fed expectations. So the perfect situation is where the Fed pricing for a particular meeting is, let's say, 50%. And the market's like, we don't know. So let's say, for example, going into December, instead of being 89% for a cut, it was 55 or 45. Then the market can move a lot. So you always have to understand that. If it's priced into 95%, it's actually asymmetrical because like soft data is not going to move the Fed. And hard data, the market says, well, Powell didn't say anything, so that's not going to do much. Much more interesting if you have a few weeks. Remember, the Fed is only 1 week away, and Powell's not going to say anything. So December is finished, right? December is finished. The only next thing which could happen is something crazy, okay? What's more interesting would be 3 or 4, let's say, for example, between Fed meetings is 6 weeks. Let's say, for example, it's 1 month before, and let's say that the Fed pricing is maybe 50%, 45, 50, 55, 60. That's going to be much more sensible. It's going to be much more sensitive. Maybe that. And then the other thing to keep in mind, which will make data move, is the magnitude, like the standard deviations from the estimate, which you mentioned before. So in a perfect scenario, and you want something like the Fed is 50-50, it's still 3 or 4 weeks into the future, and the move and the actual realized data is 2 or 3 or 4 standard deviations outside the expectations. Then you could have a strong move. And fourthly, and maybe even the most important, is if the data contradicts the sentiment in the market. So let's say, for example, everyone's thinking, oh, the data is going to be soft and labor market terrible and the economy collapsing and everything's bad and bad and bad and bad and bad. And suddenly, let's say you get a non-farm payrolls of plus 300,000. So it's also very important to, if it contradicts the market narrative. So you need to understand all of those. You need to prepare in your brain before the data comes out. And if you have all of that, then you'll probably get a very big move. And more importantly, you'll have a second push. So maybe in the first minute, we'll go boom, down maybe, and then come back a bit, and then boom, 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 down more. You have more confidence.
But these asymmetric opportunities exist
Once a
very
month.
rare. Once a month?
I
Okay.
don't know, twice a month. It depends on the situation.
Because when I start focusing on this kind of opportunities, I realized that my, the quantity of my trades become less and
Yeah,
less
yeah,
and less.
yeah. For sure, it's difficult because the problem is you're always competing against algorithms who obviously are faster than you. So it's very difficult because algorithms, they're like the lion. They're going to eat 95% of the animal and they'll leave, a few percent, a few ticks for the retail guys who are like 2 minutes late. They go, okay, great, go ahead. So it's problematic. So really you have to think it's something which, or you always let's use a simple word, something which is going to shock the market. So really what you're trying to think is what would shock the market at the moment? What is anti-consensus? What is not priced in? It's as simple as that. What is not priced in? So your real job, there's two ways of looking at this way of trading. You could either just be reactive and say, oh, that's against the consensus. The Fed is priced 50-50, or it's against it's a big shock. Okay, then you can click and trade. No problem. Always look for a good retracement. But the second way is to be a bit calmer and is to say, well, okay, the Fed is priced, for example, the Fed now is priced 90% to cut in December. Okay? So what is asymmetric? What is asymmetric is, let's say, if we got very, very, very strong data or something else, maybe Trump has a different person to go to the Fed. And then you have to structure the trade in a different way. And then it just becomes probability. Say, well, maybe I'm going to lose, but it's 90% priced in. I'm going to do, let's say, a long option, a long put on the sofas or a long put on something in case, something changes. And at that point, it becomes more of a probability trade. When something's incredibly priced in and asymmetric, often to take the contrary view is going to be a cheap way of expressing, a possibly different result. Okay, so what I like to do is just look at extremes of pricing, and yeah, that doesn't happen every day, and sometimes it happens more. The perfect situation is, and like just in terms of different markets, like if you look at, let's just go back to, let's clean this up a little bit. I mean, let's pick a market like, I don't know, the 2-year yield, for example. Okay, so what is this telling you? This is the 2-year yield on a daily. I mean, obviously the market is saying that this is the level and it really shouldn't go. So the market doesn't want to go too much more. It could go out, like it's clearly this is the level. So, I mean, do you believe there's any hawkish possibilities? So probably at this point, I mean, you look at it, At this point, the market has said, okay, we don't want to go lower in yield. So if you, let's say, for example, go long the yields here, so which is to short ZT, if you want to short ZT, you say, well, okay, I don't exactly know, but anything which is a bit hawkish, it's quite good risk reward because it's essentially a good risk reward. So at that point, you start thinking of trading as not trying to predict the future or react. It's simply looking at what's priced in, what is a mathematically good high probability trade, right? And so you say, well, so is the best way to trade that just to click on data? Maybe not. Maybe the best thing is to, for example, do an options trade and say, well, okay, maybe there's going to be something hawkish in the next 2 weeks. I'll do a long call on the ZT, for example. And at that point, it's simply so we can go to ZT. If we go, let's look at that. Well, let's say ZF. We'll go to ZT. Can you see this, guys?
Yes.
Okay, so if we go to ZT, so this interactive broker, guys, the options on the ZT, right? On the bond futures, which we should all be trading. So let's say, so look at this, 21 days. So your underlying futures contract is March. This option on the ZT is going to expire in 21 days. So it's going to expire on December the 26th, right? So here's my point. If you think, well, ZT probably won't go down too much more, right? But there is a chance that something hawkish will happen. You can simply buy a relatively cheap option for a month on long, or let's say short ZT, actually be short ZT, a put. You say, okay, all I need is some hawkish data or something, and I'll make money. Now, you could lose money, of course, but I'm saying that's the way to think. Think in probabilistic. So here you puts. So, you could buy, look at that. You could buy an 18 delta. See this delta here? So it's a put. Give you 1 month, basically for hawkish. Now, how much is that going to cost you? It's only going to cost you the 2, which is not much. There you go, $63. There you go. That's pretty cheap. Can you guys see this performance profile?
Yes.
$63. Okay. So for $63, you could do a low delta, cheap semi-lottery ticket. Basically anything hawkish, the ZT price will go down and you'll make money on your put. Now, you could also lose money, but $63 for one contract, and you can relax Yassine for a month. You say, okay, whatever. So that's the point. Like, if you're trying to react, what I increasingly I try and do is, as you say, it's relatively rare and difficult to just get data and go click and you make money. It's difficult sometimes if everything is lined up, which I said before. But if you look at things which are extremely priced in, a better way to do that, in my humble opinion, you put on an option structure, which is cheap, and you say, well, all I need is something hawkish, and I have my long put on the ZT futures, for
So
example.
you play a low risk, high profit, low probability trade, low probability scenario.
Yeah, it's deep out of the money. It's like I think it had a delta of 20, so it's out of the money, so it's cheap. $63 for one contract. That's your maximum loss. And if, for example, if the Fed does not cut in December next week, that would make a lot of money. The market would go, oh my God.
But that's almost impossible.
Don't use words like impossible. It's very important, guys, to everyone, as a trader, probabilities. I'll tell you, the market is giving it an 18% probability. The delta is 18. I don't use words like possible or
Almost impossible.
No. I'm being very serious, Yassine. Don't use those words. It's psychologically false. No one knows the future in trading. Nobody knows what will happen. Your job is to look when things are overextended or kind of underextended, overly priced in or not priced in, and you're looking for cheap ways to express a different reality to what the market is pricing in. Please never, at least in my company, try not to use psychological terms like this is going to happen. The market doesn't know. The market will do whatever it wants. Nobody knows the future. So all I'm trying to say is that, and again, we can look at the SOFR contract. You see what I'm trying to say, guys? Is that clear to everyone? Right? It's just probability. Now, will the Fed cut? Well, I don't know. Let's look at the Fed Watch tool. What is it telling us? It's telling us 90% it will cut. But remember,
next meeting, it may happen for the January meeting. It is
possibly. But all I'm trying to say is think in probabilistic terms, because the other issue is that with the ZT, the 2-year bond, it's not only the Fed, it could be hawkish data. It could be the new Fed chair. Let's say, for example, tomorrow, Trump comes out and does not nominate who everyone thinks he will nominate, which is Kevin Hassett. Let's say Trump comes out and nominates someone else like Kevin Warsh, who's maybe a bit more hawkish or less dovish. The market will definitely. So the point is about doing a ZT option, a put. It's not only about the Fed cutting, it's about data, it's about what Trump may or may not say, it's about other things. So for me, it's kind of a good bet. So to use your words, oh, that's impossible, I would say, yeah, it's low probability, but hey, $63, I get 1 month of stuff to happen. That's pretty good. I mean, what happens, for example, if we get some economic data over the next 2 or 3 weeks, which is super, super strong, super hawkish? The ZT bonds will go down. My put will go up. Or another way, if you want to be more specific, we can look at the SOFR contracts. So let's look at the SOFRs. Let's put that in here. So go SR3. Whoops. I always forget it. Is it? No, it's SR. I hate interactive brokers, huh? Oh, there we go. So let's look at the SOFR contracts. Can you guys see this?
Yes.
So we can go in and say, we could go, let's say, out to June of 2026, right? See this? SOFR 6 months of 26. Okay, so there it is. So we'll bring up the option chain. And again, how much time do you want? Let's say, I mean, I'll just do an example here. You see how it works. So let's say 42 days. You say, well, I don't know. Again, this is basis points it's going to cost you. So you could get out of the money. See the delta here. So you can get a 23 delta, so it's out of the money. You know, it's going to cost you 4 basis points. 4 basis points. It's not much. Then it's going to cost you $100. Basis points, $25. So basically what you're doing there, you've got 42 days. The expiry is January the 16th. 4 basis points. You'll break even. So all you need is something hawkish, data, the Fed. Let's say, for example, Jerome Powell comes out and says, we're going to cut in December, but we're not going to cut for a long, long time because we're super worried about inflation. And on the same day, Trump comes out and says, oh, Kevin Hassett, we're not going to nominate. We're going to nominate someone who's more hawkish, Kevin Warsh. That long call, sorry, we'll do a long put. I did a call, but actually it should be a put. You're paying 4 basis points, right? Now, if we look at the chart, we'll bring up the SOFRs. Can you guys see the chart here?
Yes.
Okay, so put on the SOFR contracts. I always forget what it is. Yeah, SOFR. Let's put it on, let's say, March 26. That's a daily. What we're basically saying is that trade we may want to put in, which, you know, you could say it's low probability, but it's going to cost us 4 basis points. which is that much. Oh,
Mm.
yeah, there we go. So you see here 0.4, that's 4 basis points or 8 ticks. So your break even is here. And you've got 42 days. But look, this thing can move a lot in one day. Look, guys, this thing can move a lot in one day. Now, is that a good trade?
Yes.
No, I don't know if it's a good trade. The option market is telling me it's got a 20% chance of being a good trade. Okay. That's why we have deltas. That's why you look at options, you look at the delta. Options, guys, by the way, it's completely not a sophisticated way of looking at options to go, oh, I want to go long or short. You have to think in terms of probabilities. So it's really the wrong question is to say, is that a good trade? It's saying it's got a 20% chance of making money and is priced appropriately. If it was deep in the money with a delta of 90, it would be a lot more expensive. But maybe that's not a good trade. I think it's a reasonable trade because I don't know what's going to happen in the next 42 days. And I think there's a chance that the market's getting a bit too comfortable about what Trump's going to do. Because Trump is not stupid. He's a bit crazy, but he's not stupid, in my humble opinion. And I think he really, if you've been following what's been happening with the Fed, basically bond professionals called the TBAC, Treasury, there's like a committee, right? The Treasury literally goes and has a cup of coffee with bankers and bond traders. It's called TBAC. And they talk about stuff. It's kind of like a club. And what the gossip is that the bond market professionals have communicated to Scott Bessent, the head of the Treasury, that be careful, guys, the market will not appreciate someone who is purely a Trump puppet. The bond market will go crazy and nominal yields will rip higher and probably inflation expectations will rip higher, which could have an effect on the real yields. So Trump is being told, being whispered in his ear by Scott Bessent. It's like, think about it, guys. Remember Trump a few weeks ago saying, oh, I'm going to announce the new Fed chair very soon, before Christmas. Now, what is he saying? Oh, maybe after Christmas or later. I think Trump's thinking, because on one hand, Trump would like a puppet at the Fed, but everyone around Trump is saying, Mr. President, you do realize that if you appoint a puppet or what the bond market thinks is a puppet, we may actually have skyrocketing yields, which is not going to be good for mortgages. It's not going to be good for the economy, and it's not going to be good for affordability, and you may actually lose the midterm elections. So therefore, Mr. President, with all respect, you may want to choose someone who is more acceptable and has more legitimacy with the professional bond market, which may be, right? And therefore, if someone new is appointed, that would be a bit of a shock to the market and a surprise. And those short-term bonds, the 2-year or maybe the SOFR for something in 2026, they're going to go down. So if you have a cheap put, you're going to make money. On the other hand, maybe everything I just said is complete fantasy and you'd lose your premium, which we saw is $100. So that's the way to think. You've got to think that the markets, guys, are probability weighing machines. It's not about being right or wrong. Probabilities are shifting. You know a probability curve? Yeah? Imagine a nice bell curve. I want you guys to imagine you've got a curve, but it's on rollers. And it just rolls back and forward to the left and to the right. And that curve is in the middle. So all I'm trying to say, at some points, the market rolls a lot this way. Some points it rolls a lot that way. Your job is to go, it's like silver at the moment. Okay, what's the probability that silver's going to keep on ripping higher? Maybe. But at a certain point, if it's super, super overextended, you go, hey, I'll give it a shot. That's all trading is, guys. It's also more relaxing to trade that way. Think in terms of probabilities. Always be looking at when any market, a stock, a bond, an option pricing, blah, 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 a Fed pricing. If it gets extreme, normally you should be thinking, maybe is there a cheap way, an inexpensive way of expressing a contrarian view? And then you do it, and maybe you're right or maybe you're wrong. But that's not really the point. You see, in that way, it's just probabilities.
So you mean Angus anticipating the shift of the narrative, before the facts?
Yeah, you could either react to narratives, but there is two ways of trading. You could react to narratives or data releases or new information. But in order to do that, it needs to be a strong continuing move. You need to be able to act very, very quickly with the appropriate instrument. Is that possible? Absolutely. If I have my chart open now and I hear, what would be crazy? China invades Saudi Arabia and destroys all oil producing facilities. Is it a good idea to click long oil? Yes, it is. Absolutely. Because I know that that's going to go up $12. So if I miss the first 300 ticks, I'm still going to make money. I'll just be clicking. Good. Yes, absolutely. But what I'm trying to say as well is that oftentimes a better way of, I don't want to say better, another way of trading is to constantly be looking at all kinds of markets, individual stocks, Netflix, like all of this nonsense stuff, Fed pricing. Do you remember about a year or two ago, the market was pricing in 8 Fed cuts? I think it was like 2024, like January of 2024. Everyone's going, oh my God, we're going to have a massive recession, a massive recession, a massive recession. And pricing for the Fed became ridiculously dovish. But the data continued to come in relatively strongly. And I remember at a certain point going, hold on. Like the employment situation is strong, the PMIs are strong. I think the market is getting a little exagéré. Now, do I know what the data is going to be in the future? No. But at a certain point, if the market suddenly, went, and we can look at, let's say, the ZT as a proxy for that period. Let's look at the 2-year yield. If we go back, we'll go back on a weekly just to give it a bit of context. I forget when it was, but maybe it was something like here or something, back in September of 20, or maybe it was here, I don't know. Basically, when the yield was low. And at a certain point, it's as simple as saying, guys, relax. Maybe the Fed will cut 3 or 4 times, but 8 times, I think it even got up to 10 cuts in 1 year, like basically a huge recession. At that point, you can just buy an out of the money long put very cheaply, and I'll keep it in general terms, a cheap way of expressing a contrary view to an overly exaggerated market sentiment. I know it's a bit of a strange way of expressing it, but that's what you're trying to do. But the point is, I'm not saying, oh, just buy lottery tickets every day. You have to wait for situations when the market does seem to be, it's just gone one way too much. Maybe even like Nvidia, Marco was talking a lot about the $5 trillion stuff. You go, okay, guys, enough's enough. Now, can Nvidia become a $5 trillion company or a $6 trillion company? Yeah, of course it can. But maybe in the short term, it's a bit overextended. Okay, is there a cheap way I can express that I think there's a reasonable chance that the market will mean revert? It's almost like a mean reversion kind of strategy. Okay, yeah, let's buy some 15 delta, some 20 delta Nvidia out of the money put spreads. Great. Now, everyone has a different market they like. FX, I like bonds and the Fed and all that kind of stuff. Great. If you like single stocks, the same point, guys. Always be thinking in terms of when is the market probability weighing machine? When has it rolled too much to the left? When has it rolled too much to the right? Look for a cheap way to express an opinion about that. And you place your bets, ladies and gentlemen. And that's all trading is. Because it's not psychological, guys. You're not going, I'm going to be right. The market's dumb. That's very stressful, guys. Too much ego. Too much ego. Probability weighing machine. Okay, time for one quick question.
Well, I think you had partially answered it, but I was gonna, I guess, push more on that and say what would be factors we would look for
Yeah,
if
of
you're
course,
looking at a low
that's
probability, you're looking at a low probability event. What would be some things to look for to say, here's a reason why you
yeah,
may want to?
yeah. And Melissa, great question. And of course, I could give you an annoying answer and saying, of course, that is the art and experience of trading knowledge. It's
Trading.
like, well, that's the whole point. When you know that, but I'm not really a fundamentals stock kind of guy, but it could be something. I think in terms of narratives. You can also look at chart patterns when things, it's a combination of things. You could look at, I would say, just just have the 10 or 20 or 30 instruments you're interested in, and you're constantly looking at the chart patterns, the narratives, and fundamentals, and just putting it all together. And it should come to you in a fairly obvious way. You almost, I have to have that little person in my
Mhm.
gut who go, or that little man on my ear whispering into my ear who goes, okay, this is getting silly. This is getting silly. If I ever hear in my ear, this is getting a bit silly, then you start looking a little bit deeper into it. So, for example, I mean, we can look at a few things. Let's look. I mean, what's getting a bit silly? One could argue. I mean, let's look at silver, for example. I'll put it on silver. Now, again, oh my God, it's ripping even higher today. See, this is
Yeah.
getting interesting here. Okay. So, Mamma mia. Again, at this point, see, I look at that chart because, of course, the important thing to do, the great investor, macro investor, Stanley Druckenmiller, I hope you've all heard of him. He's an old grumpy guy worth a few billion. What does he do? You probably said, he says, every afternoon I look at about 200 charts. And that's what I do. You just flick through the charts. I flick through about 100 stock charts every day. I just go boom, boom, boom. I just flick through everything if I have no specific ideas. And then you look at silver, you come across this chart and you go, what is that telling you, Melissa? I go, wow, that's getting parabolic. That's pretty crazy.
Yeah.
Now, so what I would immediately do is two things. I would look from a technical perspective. Now, what do I mean by technical perspective? You see here, I already have on the Fibonacci extension. You see, boom, boom, boom. It's already getting a bit overextended. And then I would look at a bunch of technical indicators, which I have a lot of them. I would look at all the moving averages. It's like, okay. And I'm just then, I would start looking at things like, the point is also you should have all this stuff ready to roll. I look at stochastics, which is simply, and you go, okay, it's super overextended. Okay, but we kind of obvious there. Then I would look, for example, at uh, the, I'll just show you some of the things I look at. Oh, where is it? I've got my standard deviation bands. So, Bollinger Bands, I have three standard deviations. So you're starting to see, that's the middle one. That's one standard deviation, two standard deviations, three standard deviations. Remember, that's 64%, that's 95%. This is 98% of times. So you can start to see like it's pretty rare if this gets into two standard deviations. And look at that. See how it reversed on two standard deviations? At this point, see, this is the interesting thing. You could argue here that actually there's maybe more to go. Because from this perspective, the volatility has really exploded. And you could argue that actually it's not actually overextended. So on one hand, it's overextended, but you can say, well, it's technically it could go up here, and it's not two standard deviations. So that,
That
that
would
would
be
make,
all-time highs.
that
Wow.
would make me a bit cautious. And then I have a couple of other indicators I look at. And again, this is all within the realms of, um, this is some stuff I put on, which is more, this is like a directional stuff, indicators. There's the Bollinger Band. So on the daily Bollinger Band, it is getting overextended. Um, but, it's just a strong, because the interesting thing here is that you see how it was bought. Sorry, it was sold. So from a technical perspective, this actually blew off some of the exuberance. And then guess what happened? It was immediately bought on the fib retrace, a very short-term fib
Yeah.
retracement, and it's ripped higher. So at this point, technically, what's it telling me? It's going a bit crazy, but is it an obvious short? And in a sense, the fact that it sold off 2 days ago is saying that some of the exuberance was taken out of the market and then it was immediately bought. This is a very powerful bull trend. Then, of course, so technically I'm like, it's not perfect to short. It's a bit dangerous. And then, of course, I would look at the fundamentals, which, because I follow silver, I kind of know in my head. But if it's something I don't follow, let's say like, I don't know, the price of bronzepencils.com, I would actually, do you like that pencil, Sky? It's a really nice pencil. I don't know if you can see it. Beautiful old antique bronze pencil. Anyway, that's not wrong. The point is, I would then look at silver fundamentals and say, why is this thing ripping insanely? And the problem is that the big macro picture is actually quite supportive for silver. And there's a big short squeeze happening at the London Exchange and American Exchange. And there's a lot of technical and legitimate logical reasons why there's actually a physical shortage of silver, which is causing silver futures to exponentially go higher. So my answer would then be, it's not a perfect candidate to short. I wouldn't touch it. I can't go long because it's too late. And to short, there actually is some fundamental justification for that reasoning. So I would look at that and go, not that guy, right? Having said that, the other thing to do as well would be to look at, you go, well, okay, but what about a lottery ticket put? Maybe. Okay, let's check it out. Is this boring, guys?
Not at all.
Okay, no, because I don't want to keep on going on. So we'll look at TradingView. Now, what we can do, guys, let's go into, let's put on a silver futures. Or even SLV, the ETF. I prefer to trade on futures, but that's okay. So we'll go on to SLV. Now, what have you noticed here, guys? Is it going to be cheap? Hold on. I hope you guys understand this. 52-week implied volatility percentile, 52-week implied volatility ranking. Giving us some kind of context. Are these options cheap? Now look at this, guys. The implied volatility percentile for SLV is 95%. Whoa, super, super, super high. And the ranking is 59%. 95%. So what is that telling you? It's telling me, now let's go onto, can you see my drop-down menu here, guys?
Yes.
So new window. Let's go into option advanced tools. Let's go into the volatility lab. Now, can you guys see, can you see a new thing come up or you see the old page?
No, we still see the old page.
Okay, so I have to stop share. So this is the volatility lab on IB. So what am I trying to do here, guys? I'm trying to understand whether lottery tickets on silver, SLV, are expensive. So I'm going to go into implied vol here. Can you see that? Or do I have to reshare? Can you see sort of a full page of implied vol,
Yes.
guys? Yeah. Okay, so let's go back 1 year. Now, we've got different strikes. So what strikes? We've just got 3 strikes. Now, what is that telling you guys? It's telling me that historically, I don't know even if we can go back, let's see if we can go back 2 years. I don't know if we can go back. That would be, we'll go back a year. What is it telling us? It's telling us, guys, that we have pretty high implied volatility. Like we're not down here. We're actually up here. Now, it has been higher, but it's still relatively high. Okay. What's the point? If I did want to do a lottery ticket and short SLV, I could do a long put. But I'm going to pay. We saw that it's in the 95th percentile. Yeah. It's historically quite expensive. It's like, that's not. Remember what I said earlier on, a cheap way of expressing a contrary opinion. If implied volatility on any product is in the 95th percentile, it's incredibly expensive. And in fact, the chances are that your implied volatility will come down, in which case, even if you're correct from a directional point of view, your option premium will automatically decrease because your implied volatility is collapsing. So I'm like, that's not so good. So the problem is on silver, it's not so good. Right now, I can look at silver futures, and I'm just going to do this for my own amusement here, so do bear with me. So I'll put on silver futures here. Can you see the black screen here? Yeah. So if I do, I think we're in the February contract. So silver futures, oh, it's not giving me the implied. Oh. But again, another way of looking at this is you say, well, okay, I think, silver's going to come down. It's getting a bit crazy. Let's say by December the 23rd. So what is this, guys? This is 18-day DTE, so to speak, expire in 18 days on silver futures. Oh, it's the March contract. Okay. So similar kind of deal here. I mean, now the point is, guys, if implied vol in this one's 41%, 48% delta, so basically at the money. Now, if implied volatility is very expensive, does that automatically mean you cannot trade it? No. It means that you want to take advantage of the high implied volatility by selling some implied volatility. So maybe instead of doing a long put structure on silver, for example, of course, a simplistic way of doing it would be a put spread, right? So, we could look at, let's say, the silver thing here. Now, silver is expensive. So what we're going to do, just to show you guys sort of the logic here, do a vertical spread on silver futures. So in 18 days, I'm basically saying at some point, I think this guy's going to come down. So it's going to be a bit expensive. Let's say we do, a 46 delta long. Oh, hold on. Oh, I've still got Netflix there. Hold on. Let me clear all X. Okay. So you see what I'm going to do? I'm going to do a put spread. So let's say we do like a 46 delta long. And then let's say we do a 20 delta. Let's have a look. You see, I go by deltas, guys. You don't look at strike prices. You look at deltas. Anyway, you get the point. I'll put it here like well, there's a lot of strikes here. Let's put it down. I want to go much lower. Let's well, implied vol is super high. Oh, here we go. Sorry, guys. See the deltas here, guys? 20.
Mhm.
Okay, so what I've done here. So I'd be buying a 46 delta, so just out of the money. So that's pretty aggressive. And I'm selling a lower strike, obviously, so 59 to 55 on the futures with a delta of 20. So my combined delta is basically 25. Now, this is going to be expensive. So don't freak out. $7,000.
Oh, wow. Okay.
Okay. But of course, again, you can do it on the micros. That's the full one. Silver is expensive. But $7,000. But let's keep in mind the strikes 59 to 55. 59 to 55. Again, I'm just showing the logic here. So let's go. Let me just clean it up. 50. What did we say? 59 to 55. Can you guys keep that in mind?
Mhm.
Okay. So what we're saying here, and again, I'm just going to show you just little tools, guys. So for example, oops, no, it's not that one. So for example, see, I've got my bar here. I've already got my credit spreads and my debit spreads. Make life easy, guys. You see what I've got here? Everything's pre-done. So I've got my debit spread. So what did we say? We said 50. What did we say? We said
59 to 55.
Yeah. So you see, it's actually very aggressive. That's why it's expensive, because it's at the money to 55. There's something like that. And of course, the expiry was about here, whatever. Okay. So basically, that's my spread. So long put here, short put there. So I want this guy to, essentially do something like this. Oops, hold on. This would be beautiful. We want something like that. Agree? Now, it's very expensive, 7,000. So let's just have a look. How many ticks does that represent? But keep in mind, guys, you got about 700 ticks. Now, how much is silver the full contract? $25. So you're talking 700 times 25. So it seems expensive, but actually maximum profit's about 17,500. So actually it's 2.5 to 1. Not too bad. Now you can do it with the micros, and again, you don't have to make it as aggressive as possible. The point of the exercise is just to take you through different ways of thinking about stuff, right? You're looking for opportunities, you look at the technicals, you check with the fundamentals, and then you say, well, okay, if I do want to proceed, what is the appropriate way of expressing it? Now, if you know, that could be option, and the point is, Yassine, options, because often directionally on silver, you could be stopped out in 2 seconds. And now, also, what I'm trying to say is that if the optionality is expensive, high implied vol, how do we know? Okay, let's get like a 12-month look back period and get some kind of historical context. But for example, on IV, they have that nice little tool, implied volatility 52-week percentile or ranking. And that gives you the number immediately. And if it's 95, you go, oh my God, that's expensive. So at that point, you want to be selling some kind of optionality, or at least waiting for it comes down. You know, it's all different things. If that was a lot lower, I'd be more comfortable. So I'll just buy a lottery ticket, a long put. But if it's expensive, maybe I want to do a spread, because I'm actually, by selling that expensive volatility, that's going to help me. Make sense? Probabilities, guys. You don't need to predict the market. You just look at what seems to be overextended, you know. And silver's a super interesting one, because there's something really, so for silver now, what would change our minds? We've seen that some of the big macro picture is still quite supportive, but it is technically getting a little crazy. The problem is that the fundamental, so at this point, what's the next step in my process? Silver, hypothetically. What would a good trader do now? We've identified that, David Gomez is saying something? No? Okay. What you need to drill down on now would be something about the short squeeze on the futures exchanges in London and New York. Because that could be any sign, and that's where silver came down before a couple of weeks ago. Any sign that that is easing, that's going to be the signal to short silver. And you see, I've already done my research. You see, it's in my brain now. So a good trader, I'm not going to trade silver now. But a good trader, I've already done the process. You see, I've gone through the fundamentals, I've gone through the technicals, I've looked at different ways of expressing it. Okay, implied vol's high, SLV, maybe futures, it's kind of crazily expensive. Maybe the micro futures would be better. But now, if I see that the short squeeze is over because of stuff changing at the exchange, I just see a headline or news, I'm kind of ready to go. I don't have to start doing everything. And that's what you're meant to do all day as a trader. Like in my brain, I have 20 or 30 of those things. They're in my brain. So if I see something now saying Trump definitely decides not to consider silver a critical mineral and will definitely not be placing tariffs on silver or copper imports, what's going to happen? It means that the premium of New York Exchange silver is no longer a valid reason. Because what's happening is that everyone's basically shipping physical silver to New York. And if that rationale ends, traders will go, okay, let's dump our silver. Remember that copper collapse we saw about a month ago? Right? Similar kind of vibe. Silver suddenly will collapse because the rationale for that. Someone like me, I'll just hit SLV because we also know that the implied volatility will go down. So in that case, I'd probably just hit an at the money, a 3-day long put and just click it super quickly and sort of hold my nose and see what happens. Because I also know that implied vol is at a crazy high level and implied volatility, well, maybe actually, no, that's not exactly true because I'm paying a lot. So maybe I'll just do a spread. I'd quickly do a spread. But the best way to do spreads, guys, is think about the delta. Don't think about the strike price. I never look at strike price. I only look at deltas. It's the only thing which interests me. So I'd probably do like a 45 to 15 delta or something. 35 delta spread. And you can do that pretty quickly. I can do that within 30 seconds, more or less. Okay? But you see, I've done all the background. So that's what I'm trying to say, Melissa, is that to understand if something is an opportunity, It could be that you read or know about something and you check everything. Or it could also be that if you're bored, you're just flicking through charts. So again, I'll end on this. But if I'm bored sometimes, or I have no particular trade ideas, I'll go to, can you see my watch list here?
Mhm.
So
Yes.
I will go to, let's say, I don't know, let's say S&P 500. So I've got the S&P 500 stocks. I think I've got the top 100 here, right?
Mhm.
So very simply, I will literally just go like this. Okay, I've got my finger on the down button. Boom, boom, boom. You see what I'm doing?
Mhm.
And you'll be surprised. Okay, I've got them all down here. This is in market cap. And you'd be surprised that you could do that in 10 minutes. You go click, 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 click. And then suddenly something will jump out. You go, oh my God, wow, like Boeing's at all-time lows. Or wow, Boeing looks incredibly overextended. You just look at the chart and you go, okay. And then you start thinking, is there a reason for this? Is it justified? How much would an option cost? Right? So you can also kind of reverse engineer it, is my point. And you just suddenly see things. Like I did a trade a couple of months ago on, this is maybe a bit technical for some of you guys, but like a Euribor. It's like the equivalent of SOFR in Europe. It's like short-term bonds in Europe. Yeah. And I just saw that it was at a super low level, like historically low level. And I just thought, you know what? Actually, should I show you the chart just for amusement's sake? Actually, no, I don't need to do it. And basically, my logic was the ECB has already cut a lot. I don't think they're not going to hike at all. So therefore, the risk reward is that all I need is something a bit, a dovish, and whatever. It was just at a very good level. Then I thought about the fundamentals, and I did an option. I think it was a long call. I think I gave myself like 30 days or 18 days. I was like, okay. And the point is, Yassine, if you're trading that way, your heartbeat is not pumping every time it's 8:30 in the morning in New York, going, oh my God, I'm clicking, and oh, I just got stopped out. How long did that take you to get stopped out initial jobless claims? 1 minute, 30 seconds, 45 seconds, 45 seconds.
Yeah.
Trust me, that's a stressful way to live your life.
Mhm.
So that's okay, but it's not easy. And I'm not saying not to do it because there are certain, but you need to understand when everything is aligné, like everything is lined up in the correct way. Okay. And another way is simply to go, I don't want this stress. I'm going to look where things are overextended and I'll use an option structure, which means, I think it's relatively good risk reward. Probabilities are okay. And of course, to get back to Melissa's point, how do you know? Well, you do it for 5, 10, 20 years. You read every day. You get guidance and you just start doing it. But the important thing is to understand, option mathematics and understand how you're using those options as well. It's difficult to do that kind of stuff just with a linear kind of trade, like long or short something. It's much more forgiving but the point is you can do relatively cheap things. So the real question is, Melissa and everyone, and I'll finish on this, is constantly be asking yourself, I read some nice quote the other day. What was it? The quote was, what is the market consensus for this instrument? What is my variant perception? What is my different view? And what would the trigger be? 3 things, right? What is the market thinking or priced about a stock or an ETF or a sector or the Fed? What is it thinking? Do I have a different view or probabilistically think that that's maybe a little extreme? And at that point, you can put on the trade, or you can say, even better to say, what would be the trigger to cause the market to reconsider, repenser kind of thing, their consensus. So in talking about the silver thing, a lot of this has been the physical shortage or the shortage of physical silver at these exchanges. So the only thing I'm listening to for headlines, that would be the trigger. You see? So just be looking at everything. For example, Netflix, they bought a Warner Brothers Discovery. Is that a good deal? Is that a bad deal? Okay. So this morning it came down and then it started to go up. So that's the point. You've got to be thinking if they do that. So for example, that's been in the news the last 3 or 4 days about Netflix. We knew that Netflix was one of the suitors, was one of the possible buyers of Warner Brothers Discovery. So then you do a bit of research and you say, well, is that actually good? Is that good for them? I mean, short term, they're going to pay, I think it's $70 billion, which is not great. But medium to long term, in my humble opinion, that's actually means Netflix is becoming more monopolistic, more of a monopoly on streaming services. So if we look at the market reaction to that, and it's just kind of an interesting one. Let's go in 3 minutes. So I put a 3-minute chart. Stock. Whoops. Netflix. Oops. Yeah, interesting. So it gapped lower, went higher, filled the gap. Oh, it's come down. I wonder why it's come down. That's interesting. But see, anyway, not saying it's good or bad trade, but if you thought it's not bad, you go, okay, what's the trigger? The trigger is if I get a good price. And at this point, it's a good risk reward for a short-term trade. You go, you know what? I put a 0 DTE on it, long call, but you've done all that work before 9:30 is the point, guy. So what I like to do, again, just to finish, is every day I kind of ask myself 4 or 5 questions. I ask myself questions, say, what questions is the market trying to answer today? Or what are some interesting questions the market is trying to answer? And that could be technical levels. So for example, is a 30-year bond going to break a very big level? Or is it like, oh, what will the market's reaction be to Netflix buying, Warner Brothers? And that's what you do. And then your preparation is, well, this is my preparation, maybe not you. Everyone is different. My preparation is then to go, okay, what instruments could I use? So for example, this morning on Netflix, I was thinking, okay, like, is Netflix expensive? Oh, actually, it's kind of down. It's already on the daily charts. It's come down 61%. That's not a bad entry level. Okay. Put it all together. Read a couple of articles about Netflix and Discovery, and you put it all together. You say, well, okay, and that way, and then literally on your option chain, you have everything ready to go, so you can act very quickly. On IB, Interactive Brokers, you make sure you've got Netflix loaded. You look at the option chain. You go, okay, I'm ready to go. How much are the premiums? Okay, boom. You can actually do it very quickly, but you need to do a bit of pre-work. So that's what I do. I'm constantly looking at 4 or 5 interesting things, questions the market needs to answer. That's it. I'm not trying to predict markets. I'm trying to look at extremes. And then if I look at it, something which is an extreme, I then say, technically, is it justified? Fundamentally, is it justified? And is there a good way to express this? A good way to express it. Remember, the most important thing in trading, guys, is the way you express the trade, in my humble opinion. All right, I think it's lunchtime, 1:20. My God, definitely lunchtime. Okay, guys, I hope this was useful. I'm going to stop recording.